Hello everyone, this is the part 2 of chapter 20 of ACCA F3 and the chapter's name is Interpretation of Financial Statement. So this is the part 2 of this video. Before watching this video, go and watch the part 1 of this video. In case you haven't watched it yet, then I've linked it in the description box below. In case you would like to watch the previous videos, the previous chapters, then I've linked the playlist for that also in the description. And if you wish to watch the Kaplan exam kit solution video, that also I've linked in the description box below. So in the previous part, in the part A, we saw these, right? Just a second. Yeah. We were seeing ratio analysis. We saw the profitability ratios and we saw the liquidity ratios. In profitability ratios, we saw gross margin, operating margin, asset turnover and ROC. And in liquidity ratio, we saw current ratio and quick ratio. In this video, we will be seeing the efficiency ratios and the position ratios. Before starting with them, I'll just quickly revise the formulas very quickly. So first we saw the profitability ratios. In the profitability ratio, we saw gross profit margin, which is gross profit upon sales revenue multiplied by 100%. And what is gross profit? It is sales minus cost of sales. And what is cost of sales? It is opening stock plus net purchases minus closing stock. And then we saw something which was the operating profit ratio. And what was the operating profit ratio? It is also known as the net profit ratio. So what is operating profit? PBIT, profit before interest and tax. So PBIT upon sales revenue multiplied by 100%. And then we saw the ROCE, which is the return on capital employed. How do you find out that? Operating profit upon capital employed multiplied by 100%. How do you find the ROCE ratio? Operating profit upon capital employed multiplied by 100%. Now, what is capital employed? Capital employed is the net assets. What do I mean by net assets? It is the total assets minus the current liabilities. And then we come to the last profitability ratio, which is the net asset turnover ratio. What does that mean? Sales upon don't get confused over here. When we are talking about net asset turnover ratio, what do? We do sales revenue upon net asset. That gives you the ratio in times. Again, let's repeat. Net asset turnover ratio, sales revenue upon the net asset will give you in times per annum. And what is net assets? Net assets is the capital employed. So what is the net asset turnover ratio? Sales revenue upon net assets. It will give you in times. What is ROCE? Operating profit upon capital employed multiplied by 100%. And then we quickly come to the liquidity ratio. We had current ratio, which is also known as the working capital ratio. Current asset upon current liability is to 1. 2:1 is the ideal. Quick ratio means quick asset, which is also known as the asset test ratio or the liquidity test ratio. So quick asset is basically current assets minus inventory, right? So 1:1 to 0.1 to 1. This is the ideal. Okay. Now we are going to start with efficiency ratios. What is efficiency ratios? Let's quickly see that. Just a second. Okay, before everything, let's start with a specific topic, which is the inventory turnover period. What does an inventory turnover period means? Inventory upon cost of sales multiplied by 365 will give you the days which are the inventory turnover period. So if you want to find the inventory turnover period, the time frame of a business, then you have to do inventory upon cost of sales multiplied by 365. Why? Because the number of days in a year, and then you'll get the days. The days which you get is the inventory turnover period. Simple formula: inventory upon COS multiplied by 365. Okay. This simply measures how efficiently management uses its inventory to produce and sell goods. The time period is found out. An increasing number of days implies that management are holding on to inventory for longer time. Obviously, this could indicate lack of demand or poor inventory control. If you are taking more days to sell your inventory, means something is wrong. Alternatively, the increase in inventory holding could also be due to buying bulk to take advantage of trade discounts. So it's not necessary that only these things can be the reason. It can also be possible that you have bought in bulk to save money because of the trade discounts if you buy in bulk. Reducing the risk of stockouts. You don't want to go out of stock, so you're just keep buying extra, expecting increase in orders. Either ways, Either ways, the consequence is that cost of storing, handling and insuring will also increase. There is also an increased risk of inventory damage and obsolete obsolescence. Okay. So there is another way how to express the inventory turnover period. But instead of having that in days, if you want to find it in number of times, you can do cost of sales upon inventory, which will give you time. So this will just basically invert inventory and cost of sales. A higher turnover indicates the management hold quite okay, you can read it by yourself, we have discussed. Okay. How to find inventory turnover period? Write it now. Inventory turnover period. How to find inventory turnover period? Think about it for a second. We just saw the formula. Inventory upon cost of sales multiplied by 365 will give you a number of days, and those days, this is known as the inventory turnover period. Okay. Inventory upon cost of sales multiplied by 365. Okay. Year-end inventory is normally used in the calculation of inventory turnover. An average may be used to have a smoothing effect, although this may dampen the effect of the major change. Inventory turnover ratios vary enormously with the nature of the business. For example, a fishmonger selling fresh fish would have an inventory turnover of 1 to 2 days, whereas a building contractor may have an inventory turnover of 200 days, right? So it depends on the business. It is very specific and particular to a business for how long does it hold on to its inventory, right? Manufacturing entities may have an inventory of 60 to 100 days. So it depends, right? Every business will have a different expiry period of their products. So the inventory period will also be specific to the business. For large and complex items like rolling stock or aircraft, the sharp fluctuations in inventory according to it year end. A manufacturer should take into the consideration. So he needs to see whether a supplier is reliable or not. Demand. Is there demand for my good in the market or no? Okay, that's what we saw right now was the turnover period, right? Now we are going to see the receivable collection period. What is the receivable collection period? The receivable collection period shows on average how long it takes to collect cash from the customers. So how much time does it take for my receivables? Who are my receivables? They are my debtors, right? The people who owe me some money, who are my receivables, my assets. So that's what they are going to find out using the receivable collection period. So again, you are finding out period. So when I'm using the word period, it means a specific time period. And when you're talking about a specific time period, then the answer is going to be given in days. How do you find that now? Trade receivables upon credit sales multiplied by 365 will give you the days. Okay. Sorry about that. Yeah. So we have a receivables collection period. What is the formula of this? We saw it's receivables. When I say receivables, I mean trade receivables upon Did you get the answer? Trade receivables upon what? Credit sales? Obviously. When do you get receivables? When you have sold something, right? Upon total credit sales multiplied by 365 would give you a particular amount of days. So until now, what did we see? We saw an inventory turnover ratio, which is inventory upon COS multiplied by 365. And then we saw receivable collection period, which is receivables upon the credit sales multiplied by 365 days. Read this. Okay, increasing accounts receivable collection period is a bad sign. So when the receivable period is being increased every time, that means that something is wrong, right? Something is inappropriate over there. Why? Because we need to have a particular amount of cash flow in the business in order to function. Falling receivable days is a good sign. So what does falling receivable days mean? That the receivables are giving you the money quicker, which means it's a good sign that you are not having any bad debts, right? What are bad debts? Irrecoverable debts. We've seen that in the previous chapter. Okay. The trade receivables used may be a year-end figure or an average of the year. When an average is used to calculate the number of days, the ratio is the average number of days credit taken by customers. Okay. Take a moment and read this. I'm just coming in a second. Okay. For many businesses, the total sales revenue can be safely used because cash sales will be insignificant. Okay, read this. The result should be compared with the stated credit policy. So every time we saw the credit limits in a previous chapter, right? We used to set credit limits for every customer. So like that, we need to compare the reality with the credit limits which we had initially set. Okay, hold on. So I hope there's no doubt and you can understand. Take a moment to read this, then we will discuss. But quickly read this. Now we have what a payables payment period is, which means who are payables? Payables are the people whom we owe some money, whom we have to pay them. Right. So it is trade payables upon credit purchases multiplied by 365. What was the previous one? Trade receivables upon credit sales into 365. That was the receivables period. So the same way my payables period is going to be trade payables upon credit purchases multiplied by 365. What is it? Trade payables upon okay. So what is the payable payment period? Trade payables upon credit purchases into 365. What is the receivable period? Receivable collection period. Trade receivables upon credit sale multiplied by 365. What is the inventory turnover period? Inventory turnover period is inventory upon cost of sales multiplied by 365. You can read it. It is just the opposite of the receivables period. Okay. Now we come to something which is known as the cash cycle. What do you understand by a cash cycle? Cash cycle is a part of management of working capital. In effect, it may be regarded as the interaction of the inventory turnover, receivable collection period, and the payables payment period. The cash cycle is important to a business to ensure that it has adequate cash resources to meet the needs of the business. So, cash cycle is basically a cycle which keeps a record of the cash. For example, like a cash flow statement. What is a cash flow statement? You get to know how much cash is actually there in a particular business, right? So, why do we need it? Why do we need to have liquid cash resources in the first place? To pay current liabilities, obviously, to meet any financing commitments, to meet regularly or payroll costs, whatever costs you might incur in the period, to meet capital commitments, to meet any sales and business tax commitments that a business may have. That is what is known as my cash cycle. The cash conversion cycle can be used to determine how many days cash is tied up on the working capital. What do you mean by cash is tied up to the working capital? We basically find out for how many days, for what period, the cash which resource which I have is being used in a particular working capital. So, cash conversion cycle is inventory holding period plus receivables collection period minus creditors payment period. Again, inventory holding period plus receivable collection period minus payables payment period. Okay, the three ratios which we saw, very simple. Cash conversion cycle or CCC. Inventory holding period plus receivable collection period minus payables payment period. Say it again. What is the cash conversion cycle? Inventory holding period plus receivable period minus payable period. So whatever you have to pay, that period you are going to minus. Okay? I know it's a lot of formulas, but that's the chapter all about. Ideally, the businesses would like to have cash tied up in the working capital for a minimum number of days. In that case, like a supermarket, the cash conversion will be short. But for other businesses, the cash conversion can be long. By the way of illustration, okay. So we have a inventory holding period, we have receivable collection period, we have payable collection period. So what is the cash cycle? 10 plus 0 minus 40, right? 10 is the inventory holding period plus receivable collection period, which is 0, minus payables payment period, which is minus 40, will give you minus 30. Again, a second business. Inventory holding period 30 plus receivable collection period, which is 40, minus payables payment period, which is 35. So we are left with 35. Okay. So now let's look at this. Business 1 holds for a relatively short period of time. So there is no, well, 40 days. Okay, read this. This is just the interpretation of our illustration. Okay, moving on. Now we are left with something which is known as the financial position. So now, before we start with this, what is an SFP? Statement of financial position is a balance sheet. Okay, keep that in your mind. When assessing the financial, when assessing the financial position of a business, the main focus is its stability, how stable the business is, and its exposure to risk, how much risk is being taken in the business. This is typically assessed by considering the way the business is structured and financed. This is refers to as gearing. So what is gearing? Gearing means we basically assess a particular business based on its financial position, how stable and how much exposure it has. So how is the business structured and how is it financed? Using that, you analyze the financial position of a business. This process is known as gearing. In simple terms, gearing is the measure of the level of external debt an entity has. Debt means loans in comparison to the equity finance, which means what it has in its business raised by themselves. So what is equity? Equity is basically raised by self or the shares. So when you compare that, that is known as the gearing. Now, there are two ways using which you can find the gearing ratio. Either debt to equity ratio, which is long-term debt upon equity, it is written in the name. Okay, or the percentage of capital employed, which is long-term debt upon equity plus long-term debt. Long-term debt includes non-current loan and redeemable preference share liability. You remember, redeemable preference share were always treated as loan notes in our chapter. Remember the previous chapter? So that's why. Equity includes share capital, balances, reserves and retained earnings and revaluation surplus. We know this and we will also be seeing this in the next chapter. Okay. Now the thing which they've given in the note is something which we already know. We have discussed this multiple times. Right. Let's go to our this again. Okay. So what did we see right now? How many ratios did we see so far? We saw in efficiency. We saw inventory turnover ratio. What is inventory turnover ratio? Inventory upon sales revenue, inventory upon cost of sales multiplied by 365. Then we saw receivable days, right? Which was receivables. One second. Until now, we saw efficiency ratios. We saw the inventory turnover ratio, which is the inventory upon cost of sales into 365. And then we saw the receivable days, which is the trade receivables upon credit sales multiplied by 365. And then we saw the payables days, which is the trade payables upon credit purchases multiplied by 365. So these are basically my efficiency ratios. So what comes in my profitability ratio? Gross profit ratio, operating profit ratio, ROCE and asset turnover, right? And in liquidity I have current ratio and quick ratio. In efficiency I have inventory turnover, receivables and payables. Now we come to the last form of ratio in which we have seen the gearing ratio. So the last form of ratio is basically position ratios. Now what exactly are position ratios? So there are only two types of ratios. The first one is the gearing, which we saw. Okay, and the second one is the interest. And the second one is the interest cover. Okay. So what is the formula of my gearing ratio? Let's quickly discuss that. Gearing ratio, we know what gearing ratio is. To find the financial position of a business, right? So there are two ways using which you can find the gearing ratio. The first one is the debt equity ratio, debt to equity ratio. How do you find the debt to equity ratio? Long term debt upon equity. This will give me my debt to equity ratio. Percentage of capital employed represented by borrowings. Okay, the first method is the debt to equity ratio. The second method is the percentage of capital employed represented by borrowings. So how is that? Long term debt again So numerator is the same in the gearing ratio, long-term debt, long-term debt. Upon equity, it's the same plus long-term debt. This is basically the net assets, right? Equity plus long-term debt is the net assets. So that's what they are showing. Two types of gearing ratio. Two ways of calculating gearing ratio: debt to equity ratio and the capital employed ratio, which is debt upon equity plus long term debt, or the net assets. You know that the formula of equity and long term assets is capital employed, right? Now let's come to the last ratio of the chapter, which comes inside my position ratio only. It comes inside my position ratio, interest cover. What is interest cover? Interest cover indicates the ability of an entity to pay interest out of the profit. So it shows how able the company is in order to pay the interest. So what is the interest covered? Operating profit. PBIT is the operating profit. I hope you remember that by now. Operating profit. Okay. So PBIT upon interest payable will show you how much cover you really do have. Low interest cover indicates that the dividends are at risk. Entity may have difficult financing. Interest cover of less than 2 is considered unsatisfactory. So it is profit before interest and tax upon the upon the interest which is payable. Okay. Interest cover tax. What is the formula? Profit before interest and tax divided by interest payable. That's it. We are done with all the formulas in the entire chapter. Let's quickly discuss the efficiency ratio and the gearing ratio and the position ratio. Okay. Starting with my efficiency ratio over here. Efficiency ratio. Let's start. So first we have inventory turnover period, so which is inventory upon cost of sales multiplied by 365. And then we have the receivable collection period, which is trade receivables upon credit sales multiplied by 365. And then we have the payable payment period, which is the trade payables upon credit purchases multiplied by 365. And then we also had something known as the cash conversion cycle. How do you find out the cash conversion cycle? Inventory holding period plus receivables period minus payables period. Okay, so these are my efficiency ratios. The last ratios, let's quickly write it in the same chart. Fourth, this is 1V, which is 4. I'll just write it again. Okay, the last ones are my position ratios. So the first one in my position ratio is the gearing ratio. So there are two ways using which I can find my gearing ratio. The first way is to debt upon equity, and when I say debt, I'm talking about the long-term debt. And the second way is debt upon equity plus debt. When I'm talking about debt, I'm talking about long-term debt. Okay. And the second ratio is my interest cover ratio. What is interest cover ratio? Profit before interest and tax multiplied by interest payable. Let's quickly go back to my interest formula. This basically gives you the cover. Alright, just read it. It's very simple. Let's quickly do the test to understanding, then we'll be done with the chapter. Neville is an entity that manufactures and retails office products. It summarized financial statements for the year ended 30 June 2004 and 5 given below. So statements of P&L for the year ended 30 June are given here. This one is for the previous year, this one is for the current year, or this is of 2004 and this is of 2005. These are the statement of financial position. Everything is given. Okay. The directors concluded that revenue for the year ended fell below budget and introduced measures during the end. These included cutting selling prices, extending credit facilities, blah blah blah. The directors are now basically reviewing. So, in order to review the statements, you make ratios. You use the ratios to reconsider and reevaluate the position of my business. Calculate the ratios for the comment upon profitability, liquidity efficiency, and financial position. So we need to calculate all the ratios. That's what they are saying. Start solving this quickly, then I will discuss. I'm not going to write this, but I will quickly discuss how to solve each ratio. Okay. Gross profit ratio. What is it? What was the formula of the gross profit ratio? Quickly write it somewhere. Gross profit upon sales revenue multiplied by 100. So gross profit 406,400. We are discussing for 2014 right now. Gross profit ratio is GP upon sales multiplied by 100. So GP 406,400 upon sales. What is sales? 1159850 multiplied by 100. By doing that, you will get some 35%. Listen, solve the question by yourself and then discuss with me by watching this video and correct your answer. Otherwise, there's no point of watching this. So you will get something about 35% over here. Let's do the same thing for 2005 now. Again, gross profit ratio is GP upon sales revenue multiplied by 100%. I'm discussing the formula again and again so that you remember. So GP upon sales multiplied by 100 would give you about 24.5%. GP ratio is done. Now let's do the operating profit ratio or the net profit ratio, which is profit before interest and tax upon sales revenue multiplied by 100%. Right. Where is the PBIT? 221450. I'm sorry. Again. We are not doing PBT. We are doing PBIT, which is the operating profit. Profit from operations. Right. This is PBT. So we are not considering that. Operating profit. PBIT, which is the profit before interest and tax, profit from operations upon sales revenue multiplied by 100. Same thing over here. Profit from operations, profit before interest and tax upon the sales multiplied by 100. So you will get some 20.3 this side and you will get some 12.9% this side. Operating profit, gross profit is done. What else is there? ROCE, return on capital employed. What was the formula of return on capital employed? Operating profit where's my operating profit? 235450 upon net assets multiplied by 100. Now what is my net assets? Go to the financial position. How are you going to find the net assets? Non-current asset value is given. Equity and reserves is also given. NCL is also given. So what do I not have to include? I just don't have to include my current liabilities. Can you do that? Can you add and tell me how much is the capital employed? So non-current assets is 732,110 plus equity and reserves is 407,420 plus non-current liabilities is 831,000. This would give me 1222630. But tell me, is that the answer? Take a moment and try to tell me the correct answer. Let's do it again. We are adding the entire non-current assets. 341,400 plus current assets also we are adding 390,710. Okay. Now we are adding equity and reserves 407,420. We are adding non-current liabilities. Wait, we are doing something wrong. Let's just quickly check our answer. What is the total assets? 732,110 minus current liability. Let's just do that. Current liabilities is 241 minus 241,590. So this is going to give me 490,520. So my capital employed, yeah, we got it right now. The capital employed is 490,520. Why? Because capital employed is equal to total assets minus current liability. We learned this formula so many times and still we were applying wrong formula. We got it. So capital employed is total assets. Total assets is given over here. Okay, total assets is given over here. Total assets minus current liabilities, which is this, will give you 490,520. That is the capital employed. So how did I do that? ROCE is operating profit upon capital employed, right? So where's my operating profit? Here, operating profit upon capital employed. I think you can do it by yourself. The same thing here also. Next, we have the asset turnover ratio. What is the asset turnover ratio? Sales revenue, which is 159,850 divided by net assets, which is the capital employed, 490,520, which we found out. Right. By doing this, you get the answer in times. Same thing you're going to do the other side also. I hope you are able to do it. See, if you remember the formulas, then it is going to be very simple. Now let's come to the efficiency ratios and everything. So that again is going to be very easy. If you remember the formulas, I think you can do it by yourself. So do it by yourself. In case you have any doubt, you can drop it in the comment section below. So that's it. We are done with the chapter. In case you have any doubt, then you can drop it in the comment section below. Thank you.